Hello everyone and welcome. As we approach the final hours of the year, it's a perfect moment to pause and reflect on what's been happening in the world of finance. Whether you're an active trader, a long-term investor, or just someone curious about the markets, this time of year always brings a unique energy and a sense of anticipation for what's next. As we stand here on December 30th, 2025, we're closing the books on another year in the financial markets. The last trading days are often filled with both reflection and last-minute moves as investors adjust their portfolios, lock in gains, or prepare for the new year's opportunities and challenges. The end of the year is often quiet, but that doesn't mean it's uneventful. Holiday weeks can bring surprising market moves. With many traders and big institutions taking time off, the markets can become more volatile, and even small news stories or unexpected events can trigger outsized reactions. Globally, Asia's markets are cooling after a strong year, with investors taking profits and reassessing risks as the region faces new economic data and shifting global demand. The momentum that carried many Asian indices higher is now giving way to caution, as traders look for signals about what 2026 might hold. U.S. tech stocks are showing fatigue, with some of the biggest names experiencing pullbacks after months of rapid gains. Concerns about valuations, interest rates, and the pace of innovation are all weighing on the sector, making investors wonder if a new trend is emerging. And gold and silver have been on a wild ride. Precious metals, often seen as safe havens, have swung sharply as global uncertainty and shifting inflation expectations drive demand up and down. For many, these moves are a reminder of how quickly sentiment can change. These aren't just numbers, they're stories about confidence, economies, and your money. Every chart and headline reflects the hopes, fears, and strategies of millions of people around the world, all trying to make sense of a complex and ever-changing landscape. Remember, the market is millions of decisions, not a single entity. Each trade, each investment, is a reflection of someone's outlook, risk tolerance, and goals. That's what makes the market so dynamic and unpredictable, especially at times like these. With fewer traders, small events can cause big swings, so staying informed is crucial. Even a minor headline or a sudden shift in sentiment can ripple through the markets, creating opportunities and risks for everyone involved. Today, we'll break down Asia's pause, tech's stumble, the metals drama, and explore how these trends are shaping the global financial landscape as we head into a new year. We'll also look at what's happening in the US, Europe, oil, and currencies. Because every region and asset class has its own story to tell as 2025 comes to a close. Let's get started and make sure you're ready for whatever 2026 brings. Whether you're planning your next investment or just want to understand the forces shaping our world, this is the perfect time to get informed and prepared for the year ahead. In Asia, markets are taking a breather after a stellar year. The MSCI Asia Pacific Index is up nearly 27% for the year, its best since 2017. Japan's Nikkei is up 26%, showing strong confidence. China's blue-chip stocks and Hong Kong's Seng both posted small gains. These aren't dramatic moves, but they show stability, not panic. Investors are locking in profits after big gains, a normal, healthy end-of-year activity. The slight dips are more about reflection than fear. After such growth, stabilization is expected and healthy. The real story, huge annual growth, now followed by calm. For investors, 2025 was overwhelmingly positive in Asia. Minor fluctuations now are just the market recalibrating for the new year. Let's talk about tech stocks, the market's superstars, now taking a break. This week, heavyweight tech stocks pulled back in both Asia and the US, dragging indices down. The main reason? Profit-taking after a year of big gains. When many investors cash in at once, prices dip, even if nothing's wrong with the companies. Another factor, valuation concerns. Some worry tech prices have outpaced earnings. This prompts a healthy debate and prevents bubbles. Markets are always looking ahead. Some investors are rotating into other sectors for 2026. The dip isn't a reason to panic, but a reminder that no sector rises forever. Diversification is your best defense against these shifts. Tech's stumble is just part of the market's natural cycle. Now, let's turn to the week's most dramatic story. Gold and silver's wild swings. Silver surged to a record $84 per ounce, then plunged nearly 9% in a day, its biggest drop since 2020. Even after the fall, silver is up 156% for the year. an extraordinary return. Gold also tumbled sharply, then rebounded, ending near $4,361 per ounce. Both metals have been among the year's top performers. These swings are classic volatility. When assets soar, corrections are likely. The rapid rise was fueled by panic buying and automated trading. When buyers dried up, profit-taking triggered sharp drops. It's a lesson. Even in strong trends, the path is never straight. Precious metals drama is a reminder to expect the unexpected. Why did gold and silver swing so wildly? Short-term, it was market mechanics. Stop losses and panic buying pushed prices up fast. When silver hit record highs, buyers vanished and profit takers took over, causing a sharp drop. This is a textbook short-term bubble popping, driven by emotion, not fundamentals. But don't mistake this for the end of the story. Long-term supply deficits and national stockpiling are driving demand. Central banks are hoarding gold, and some countries are restricting exports. These trends suggest the upward move in precious metals isn't over. The correction may set the stage for the next leg up. To truly understand the current state of global markets, we need to start by examining the US and Europe, two economic powerhouses that set the tone for the rest of the world. These regions are not just financial centers, they're also trendsetters whose moves ripple across continents. Wall Street's recent tech retreat has sent cautious signals, prompting Asian markets to pause and reassess their own momentum. But if we take a step back, it's clear that US stocks remain close to all-time highs, reflecting a year marked by impressive double-digit gains and robust investor confidence. The recent pullback is more of a healthy pause than a sign of trouble, a natural breather after months of strong performance. Meanwhile, European markets are holding steady, with investors there adopting a patient, wait-and-see approach as they monitor global developments and central bank policies. This sense of stability is crucial, as it helps anchor global sentiment and prevents overreactions to short-term fluctuations. The strength of the US economy continues to have a far-reaching impact. When American consumers spend, businesses around the world feel the positive effects. From retail to technology, the ripple effect of US demand supports jobs and growth in many countries. Major investment funds based in the West play a pivotal role, influencing markets everywhere through their decisions and capital flows. Even as the tech sector faces some turbulence, the overall stability in both the US and Europe provides a solid foundation for global investors. The prevailing message is one of quiet confidence. There's no sense of crisis, just a recognition that markets move in cycles. Investors are carefully positioning themselves for the year ahead, focusing on long-term opportunities rather than reacting to short-term noise. Instead of panic, we see strategic planning and cautious optimism. The global economic engine is still running strong, powered by resilient consumer demand and steady investment flows. Minor dips and corrections are simply part of the normal market cycle, not signals of impending trouble. As we look ahead, it's clear that the fundamentals remain solid, and the world's major markets continue to provide stability and direction for investors everywhere. Oil is the lifeblood of the global economy, and its price is sensitive to world events. This week, oil prices held steady after a jump, supported by rising geopolitical tensions. Brent crude traded near $62 a barrel, WTI near $58. Tensions in Russia, Ukraine, and US-Iran have markets on edge. Any conflict could disrupt supply and spike prices. China's military drills near Taiwan add to global unease. When big powers flex, uncertainty rises, and so does the risk premium on oil. These aren't just headlines, they're real risks priced into every barrel. Investors demand higher prices to offset potential disruptions. Let's talk currencies, the world's biggest market. The US dollar is set for its steepest annual drop in 8 years, down nearly 10%. Why? The Federal Reserve's low interest rates make the dollar less attractive, so investors seek better yields elsewhere. The euro has surged, up nearly 14% against the dollar. This shift affects trade, travel, and even the bond market. US bond yields have fallen, reflecting expectations of continued low rates. For investors, a weaker dollar boosts returns on international assets and helps US exporters. It also makes foreign goods pricier for Americans. The weak dollar is a key reason gold has soared. When the dollar falls, gold rises. Everything in the financial world is connected. So, what does all this mean for you as an investor, especially as we close out another eventful year? It's easy to get caught up in the headlines and the day-to-day noise, but let's take a step back and focus on what really matters for your financial journey. First, remember to always look at the big picture. A year-end pause in the markets is not unusual. It's actually a normal part of the investment cycle, not a sign of crisis or impending trouble. Markets naturally ebb and flow, and these pauses can offer a chance to reflect and reset your strategy. Diversification remains your best defense against uncertainty. This year, we saw tech stocks take a hit, oil prices remain steady, and gold surged to new highs. By spreading your investments across different sectors and asset classes, you protect yourself from the ups and downs of any single market. Don't put all your eggs in one basket. A healthy mix of US stocks, international stocks, bonds, and perhaps a touch of gold can help balance risk and reward. Each asset class reacts differently to world events, so a well-rounded portfolio can weather storms better than one that's too concentrated. Know your assets and understand their unique risks. Volatile investments like silver can swing wildly in price, so they're not for the faint of heart. If you choose to include them, make sure it's a small part of your overall plan and that you're comfortable with the ride. There's no single best investment for everyone. The right choices depend on your personal goals, your time horizon, and how much risk you're willing to take. Consider talking to a financial advisor or using online tools to help match your investments to your unique situation. Stay informed about what's happening in the markets, but don't let every headline or alert dictate your decisions. Obsessing over short-term moves can lead to emotional reactions and poor choices. Instead, focus on your long-term objectives. The most successful investors are those who stick to a solid, well-thought-out plan through both the highs and the lows. Consistency and discipline are key. Don't let temporary setbacks shake your confidence or cause you to abandon your strategy. Remember, this week's events aren't a reason to panic. In fact, they're a reason to feel proud that you're taking charge of your financial future, learning and making informed decisions. Keep learning, stay curious, and continue building your financial knowledge. Set clear goals, review your progress regularly, and don't be afraid to adjust your plan as your life and the world around you change. The world will keep changing, and markets will always have their ups and downs. But with knowledge, a thoughtful plan, and the discipline to stick with it, you'll be ready for whatever comes next. Here's to a strong start in 2026. May your investments grow, your confidence soar, and your financial future shine brighter than ever.